Right, stocks came within a hair of getting a new high, actually closing at a new 52-week closing high point, and then we're inching our way closer and closer to that all-time high. So the market is just hanging in there. The S&P 500, that is, that's not shared across some of the other indexes, especially the Russell 2000, which was such a all-star at the end of the year, especially in December, just killing it in December. Not doing so now. And so, what does that kind of tell us? So we're going to take a look at the differences between what the Russell's telling us and what the S&P, and what that could mean, especially going into a seasonally not so bullish time of year, especially as we head into earnings season. So earnings is going to be important, and there's a important technical factor I'm going to show you today in today's video, that we need to keep in mind as we head into earnings. But it's all about trying to figure out, are we going to have a strong January or not? I've shown you before how these returns of November and December kind of lead us into potentially maybe not so good of a January. What about earnings season? Well, we'll see what the returns there tell us, what the technical signs tell us. Again, does it even give more evidence that we might not be so strong in January, or are we going to really take off again to the upside and start the year strong, and hopefully be a harbinger of what's to come for the full calendar year? So I'm going to break all that down. What's driving this action? It's a very interesting pattern that's driving this current 4-day rally. Not maybe some of what you would expect, but not all of what you would expect. So we're going to break that down. And then our trade idea is also in a space that's not associated with the Magnificent Seven, though its chart kind of looks like it should be. So we'll talk about how to trade that. So let's go ahead and get started. Today is Wednesday, January the 10th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you happen to be watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video we've got posted here. Come down to the bottom, click on this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on those platforms. It's a big deal to us. That's why we always ask. Our goal is always to get to 100 on likes on Twitter. A nice, easy, round number to try to get. I've had a harder time recently getting to that. So thank you to those who do that day in and day out. We really appreciate it. It goes a long way for us. Those who don't, you can do right now while you're watching with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. The market's closing up here, and you can see another up day and really close to not just this high point, but also the all-time high point, right? That's the high point that we're just gradually moving closer and closer towards that 4,800 level, plus or minus, depending upon whether it's a closing high or an intraday high. That's about this intraday high is pretty close to that closing high that we had back in 2022. If you to go back to see exactly what that close was, right over here, it would be 47.96 would be the all-time closing high point. So again, we were just a few points off of it. Just a couple weeks ago. Oops. Just a few points off of it a couple weeks ago on an intraday basis. But the intraday high point back then was around 4,800 plus, like 4,816. The intermediate line's rising again. It's almost back into the upper reversal zone. It never did dip out of bullish, so we're still on the same intermediate rally here. It's a new near-term rally. The momentum line spiked up, so that really benefits. And you like to see that the bigger the momentum line spike, the longer the near-term rally can be, right? So you like to see those spikes, and that's what we got here. See, this last near-term rally didn't have that momentum spike, and so it didn't last nearly as long. The one before this didn't quite get all the way. This one, the momentum line spiked, and it didn't get going at all. It took another momentum spike to really get a good long one going here, and so the one that we have now is a good sign. There's a good sign that we can stay. The market sentiment line's strongly bullish. It hasn't been this strongly bullish in quite a while. You can see, follow my cursor over. It didn't get that bullish over here at the end of that year. you have to really go back because the market sentiment line really dipped down. See, it wasn't very strongly bullish over there. It wasn't until over here that it was at much higher levels, right around 89 there, going into September of 2001. So we're not there. We're not at 29, but you notice that we are pretty close, right? We are pretty close to getting there. We're at 85, so good run on the market sentiment. We're 2% above the 30-day moving average, not back above that 2.5% mark, as we are working our way up. Again, trying to get to that. Again, this close, the 52-week high would be right around that 47.83, and we're gonna close just a hair above it by what would that be? 47.80 by 0.08 of a point. We end up closing with a new 52-week high point, even if it's not necessarily a new intraday high point. The near-term line is, like it's up there. It's going to kind of be up here for a while. So this looks good. The momentum line's dropping. That's not surprising. It will drop. It always drops after these high peaks. So that's not an issue. The issue is the Russell 2000, right? The Russell 2000 ended up today slightly negative. Its intermediate line is at the low end. It's not close to the reversal zone. It's actually at the low end of bullish trade. Now it is rising, so that's good. We're only 1% above the moving average, which you can see has a bigger envelope, so to speak, around its moving average than the S&P does. It's got more volatility. But what's the key here is that the intermediate line is actually market sentiment's not in the upper reversal zone, and the intermediate line has crossed below it. Now, it can cross back above it. That's great. But the problem is we did not get a momentum spike here on this rally that we had. We did not get a momentum spike. You probably would have if we could have held it the next day, but we didn't. So we did not get the momentum spike. So the near-term line is ended up forming this would be a bearish peak. If that near-term line continues into the bearish territory and pretty much ends this near-term rally, that would be a pretty bearish near-term peak. And you can see it crossed below its intermediate line today, not by a whole lot, and the intermediate line's not crossing the market sentiment by a whole lot. But we'd have to really reverse these pretty quickly, like within the next day or two, for that bearish crossover on both of these to be nullified, right? And that bearish peak, because that would be a bear. You notice we haven't had a bearish peak on the near-term line since really this one over here, and then we followed up with some a strong bullish short-term sentiment surge there. But all these other bearish peaks, you can see, we're in bearish moves. It's rare to be in a bullish intermediate run, dark green shading and a green line, and get a bearish peak on the near-term line, a peak that does not get above the 80th percentile. And like I said, crossing the intermediate line to the downside again for the first time, right? Because it didn't cross below it on the initial drop. It was the intermediate line was above the 90th percentile, but it's crossing below it as the intermediate line is also crossing below its market sentiment. So we really, really need to nullify that with a good, strong close of the week in the next 2 days. So that's a major difference. Obviously, this latest surge in the last 4 days or so has come from here. It's come from the Magnificent Seven, big bullish sentiment. It had dropped more, right? It actually did get a bull tag. None of the other indexes did. And so its intermediate line's a lot lower. It actually dropped below the 60th percentile. But it has turned back up as the near-term line has crossed back above it. And you can see we're making a run back up. And then finally your Dow, which has been influenced by Boeing here lately, never did dip very much, though it got pretty bearish short-term sentiment. Not as bearish as some of the others. Didn't come close to a bull tag. So no light pink shading even. I mean, we're still above the 90th percentile on the intermediate line. So hardly any weakness at all. But again, the same thing. The momentum line actually did spike up here on that a couple days ago on that big rally on Monday, but the near-term line has not breached the upper reversal zone, and this would be a bearish peak for the near-term line. Again, similar to what we saw over here as we tried to maintain the bullishness, but you kept getting bearish near-term peaks, and eventually you ran out of gas. So good charts on the NASDAQ 100, good charts on the S&P 500, some weakness showing up on the Dow, some signs of weakness showing up on the Dow industrials, Whoops. The Dow Industrials, and then of course your Dow Jones Transports is way weaker, right? It's, again, you got bull tags and we're not bouncing, and the momentum line can't spike, and the near term line is way more bearish. So, and then finally your Russell 2000 is showing by far the weakest out of all of these. So you can kind of see varying degrees, but it's, a lot was made about how that late stages of this rally was fueled by the Russell. Really from the December the 1st on, really from December the 1st to that December the 27th. If you take a look at like this chart here, December 1st, through pretty much the month of December. But if you go from December the 1st, starting on the 1st, to December, I cannot click here, to the 27th is when the Russell peaked last year. We'll change that to 2023 as well. You can see here, whoops, that's going to take a minute. Let's see, did I get that right? No, I didn't. Let's try that again. December 1st. That's why I didn't. There we go. So the Russell was up 14%, more than double the Qs and nearly triple, about 2.5 times the S&P 500. And with this very weak dollar, this is all the month of December, right? So your Russell 2000 really took off from there, right? That was when it started to really outpace. But now you can see the latest surge has not been fueled by the Russell at all. And the Russell is actually potentially fueling what may be more of a decline in these assets, these indexes. Let's take a look at the weekly chart again. Another transition candle. So we got a transition candle last week. It did not turn into a bearish reversal. All right, we got another transition again. Multiple transitions is a good sign. It allows us to stay bullish. We are pretty strongly bullish. The Heikin-Ashi candle is still pretty light. It's still below its average. So we're not out of the woods in terms of moving back up here. And like I said, the PPO is pretty strong. It's as strong as it's been throughout, since the correction started, is as strong as it's been. Remember, when this correction ended, we were right about the same levels of when it ended. And when the correction started, when that last bull market ended. So this is a pretty strong level. The NASDAQ, of course, fueling a lot of that. Not as strong in the momentum now as it was here at the end of the summer. But that's what the weekly chart's looking like from a 3 green arrow standpoint. Again, we have 2 green arrows, close to a third on the Qs. We do have the same 2, close to a third on the S&P, as the stochastics is turned up on both of those. Your diamonds, of course, the stochastics never really dipped, so it's still very high. But your MACD is a lot further away from getting a green arrow there. And then, of course, your Russell is actually closer to 3 red arrows right now than it is 3 greens. So we're, again, that's a long period of convergence. In other words, a long period of no green shading on all these indexes, and some pink shading thrown in here on the Qs. That, again, it's not necessarily like we're breaking down anytime soon, but it does go to show that we're not as strongly bullish anymore. As even the MACD is below its average. It's not below 0. That's when you start to consolidate. But you are below, it's still above 0, but you're still below its moving average. Stochastics crossed back above its moving average with very low volume today. You can also see the stochastics on this chart, the 4-week range way back up towards the 94. We closed at the 94th percentile of the 4-week range, above the average, which is still very high itself. So short little dip out of bullish territory, coming roaring back up to the upside. Of course, that's the S&P. The Russell's a little different, right? We're still in the lower half of the chart on the Russell, so a little different, and the average is now out of that upper quintile. And if you look at the Russell 2000 on this chart, again, we are still below the 17-day as a MACD. MACD is still positive, so it hasn't started to consolidate yet, break that moving average, but it is still below its moving average. So you see the pretty distinct difference here between the S&P, which is being fueled right now by the Magnificent Seven, back above 30, barely back above 30 on the positive indicator, still below 20 there. So great trend. The Qs, of course, fueling that, back above 30, not quite below 20 yet on there. But IWM, you can see the positive is below 25. the negative is still above 20, but the positive can't get going. So we just can't get any positive moves. On the diamonds, it's a little bit better, but the negative indicator is still very low on the diamonds, about as low as some of these other low levels that we had in the summertime. So the diamonds hasn't, I mean, at least we had a little bit of consolidation, a little tiny bit of consolidation, tiny on the S&P that the diamonds just obviously never did get. ADX is still above 50 on the diamonds. It goes to show just how strong that rally was. Your Russell 2000, we're still bullish, above 60, above 0, back up almost above 100 again on there. Again, the difference between the S&P and the Russell, you're still well below 0. You're still above 50 there, but you're still well below 0 on the CCI. And that CCI, remember the weekly, you're back below 100. The SPX, if you look at the weekly, you are also back below 100. So keep that in mind in terms of like, you know, if things might, you know, that's a sign of weakness in terms of the strength of the, you know, what now 11-week move to the upside that we've had going there. Looking at the Ichimoku cloud, remember we still have the trend on the S&P. We broke it on the Qs, and we have not renewed it yet on the Qs, but we still have it on the spiders. The diamonds also still, in fact, it never really did dip at all. But IWM is gone, so we lost. Today we lost the trend. What strong, mature, bullish trend we had, we've lost it. Remember, that's a big, sizable gap between the blue line and the cloud, and the blue line really ramped up today, and we're sitting right on it. So it kind of shows how tenuous the Russell is going into the end of this week, and then the options expiration week. Excuse me, next week. Looking at the Bollinger Bandwidth, hit new 150-day lows today. So very, very low Bollinger Bandwidth here. You know, dropping down, had gone up to this 987 level. It's down to the 972 because of today's move. So slightly though, but we are pushing up against the upper band. As the bands themselves have moved inside the Keltner channels, we got red dots. So a breakout above both the band and the upper Keltner channel, again, would be very, I mean, like we had here, you would have a potential for a new surge up to the upside there. Again, the different story on the small cap index, which have been so bullish at the end of the year. Again, we can't, like, its bandwidth is rapidly falling. We're at the midpoint of the bandwidth, and the bands now are really close to getting red dots as the momentum is close to flipping. And I mean, again, very tenuous situation there that we kind of need to hold in this regard. Looking at the whole moving average, you can see we did flip the parabolic SAR. The MACD has slightly crossed above, and we did slightly get a, like, it's a pretty decent size bullish candle. We got above that 2.5% mark. So pretty good candle there. Obviously, we're not close to flipping any of this, right? We're not above this, you know, we're not above whatever the equivalent level is here. The MACD is below its moving average, so clearly. And there's a big gap here to the 200-day hole as the whole 20-day hole is red, and we're still below it, and the parabolic SARs aren't close. So very, very, you know, distinct moves. I mentioned the 4-week range. We came this close to a new 4-week high. 47.55, 477.55, 477.45 is where we got to today. So we came that close to getting the green line on the Arun indicator to hitting 100. As it stands, we came off of that high point. We closed, you know, we're at 476.5. So we're off of it by about $1, and we'll see how we end up finishing. We were pretty, you know, we were $2 away from that 475. So we'll see how things go overnight and see if we can't get, you know, we really would like to see this pop back up before the red line, because that red line is going to move up pretty quickly here. Again, on Friday, so this is today, where it is today. That would be yesterday, so this is today. This is where the low point is going to be tomorrow, so that red line is still going to be at 0. But then on Friday, the 4-week low is going to move from here, barring a new one tomorrow, which is doubtful. It's going to move to here, right? So it's not going to jump, the red line is not going to jump to 100, but it's going to jump close to 100. It's going to be, what, 1, 2, 3, 4, 5, because this would be tomorrow and that would be Friday. So it's going to be 5 days away from 100. whatever that number would be, the equivalent number. So it's going to jump up. Again, we've seen that before. That's typical of convergences that do not lead to consolidations when the red line jumps, but not all the way to 100, and the green line drops, even maybe below 50, but doesn't get all the way to 0 and bounces back up. And so considering how close we are, that's the likelihood. Again, that's the S&P. IWM's a different story, right? Again, this is today, this is tomorrow. On Friday, the low point is going to be right over whichever one, this one is going to be right over here, right? So that's going to be the new 4-week low point on Friday. Again, it's going to be 5 days away, but you notice we're a lot closer to that on the Russell than we are getting a new 4-week high. So we are close to the breakout where the red line jumps all the way to 100 with the green line close to dropping below 50. The bandwidth's still pretty high. Again, shows how volatile IWM is. That's a different story on SPY. SPY, the bandwidth is down. It's going to go down again tomorrow, and it's going to really go down a lot on Friday, barring a significant new high point, a 4-week high point tomorrow. So when we are due for this is a Bollinger Band squeeze we're getting, and we're due for that squeeze to produce some kind of trending move. If it's a trending move to the upside, we're already on one, so it's going to probably not be as extended. But at least it will be good enough to get to 4,800 and finally check that off the list here. But if it's a trending move to the downside, then we've got a lot of consolidation, considering how much we've had to go here. Looking at the VIX, you can see the VIX has been so interesting. We were so complacent. We're back below 13, but we are not dropping. See, back over here when we were below 13, we were well below 85%. But the VIX is holding up versus VXV pretty strongly. So despite an extremely low VVIX, well below 80, like easily below 80 here. We haven't been below 80 for quite a while, right? It goes back to over this low point. But again, that's an extreme low for the VVIX to be that low. Again, it typically sets up a jump on the VVIX, and usually a jump on the VVIX, because they're positively correlated, tends to produce a jump on the VIX. The VIX is pretty darn low itself, just on its own relative basis compared to its averages. It's below, this 5,200. It's well below, and it's near its 52-week range. And again, at these lower levels, it limits the downside because of how low it already is. And you can see kind of how the momentum is that, there's not a whole lot of momentum to the downside here, and you wouldn't expect there to be that much more. So if the best case scenario for any upside movement is we grind slowly higher, and considering that the ATR is 85 hundredths of a percentage point relative to the price, it's going to be hard for the market to make a significant move, right? At least back over here when we started in October, we were coming off of a peak on the ATR of 1.33%. It's not too significant. Usually intermediate declines get above 1.5, and so that was a very deep intermediate decline, and it really didn't wash out very much. But it was enough to, even if you didn't expect it, a 2 standard deviation move, which is pretty much what we got, it still would have produced a pretty good move because of how high the ATR is. If we come off of this low point, you can see you would not anticipate nearly as strong of a move to the upside now, because we're a lot lower on the ATR now than we were there. Same thing with the volume for that. The volume's actually almost pretty close to where we are there. And if you look at when you normalize that volume, which is what the money flow looks at, we're actually at negative levels. So we're more bearish now. You see, we're right back up to these highs on price, but you notice we're not back up to those highs on volume. So, very, very poor money flow. And for that matter, very poor breadth too. When you look at the McClellan oscillator, it's still, in the negative 20s. It's not below minus 35 where it starts to trend, but you're still below minus 20. When you look at like other, let's see here, these other breadth indicators like the new highs. Now this won't be updated yet. It looks like it is updated for New York Stock Exchange. It needs to be updated for the NASDAQ composite as well. So usually that number will probably later tonight come down, which is what it generally does. But even at 117, it's still below the 20-day average. So the new highs and new lows are weak, and the number of stocks above the 50-day moving average are below its average, right? It's down, 429, well below the 445 average. So, you're starting to see, like, when you get below that average is when it starts to show some weakness, right? The markets themselves start to show some weakness, considering how extreme that, this, if you like, when was the last time we had the average get up to the 90% mark? You can see this blue line here. That 90% mark is what this line is. It's right about at 450. So you can see we've had a few instances here where the blue line, but this is really the last time, and we were coming off of the COVID low point, where it was an extreme bounce to the upside. We haven't had something this extreme coming off of a, at least near, when you're not coming off of a major low point. We haven't had this bullish of a move on the average itself, the 20-day average, in quite some time. All these others were coming off of a correction low point there, coming off of a correction low point there, coming off of a major correction low point there, not a correction low point here. And so in fact, you would say closer to a high than a major correction low, which is back over here, was the major correction low. And you had a pretty decent surge there too. So not quite the surge you would expect. And then you look at the 200-day, the number of stocks above the 200-day, you notice it's now flirting with getting below its moving average, which also sets up at least convergence periods, if not eventually some weakness like we've seen in the last couple of years, some pretty immediate weakness. So we're losing that whole idea that it's not just the Magnificent Seven, it's everything else is participating, and they surely did in December, but we're losing that now, and we're seeing the ramifications of that. Let's take a look at the sector. Let's see what's driving this. So you saw, I showed you here, but let's go to the 4-day returns, because that's the rally we've been on. We've been on a return, on a rally now since last Friday. The Qs are just killing it. And you notice real estate's not joining them this time. Real estate typically has been, because yields are falling, and that pushes real estate up too. But yields aren't falling. Yields are actually up. Your TLT is down. The dollar's flat. So the higher, lower yields and a weaker dollar is what's fueled a risk appetite in the past. This time it's just pure on, pretty much Nvidia, but pure on just Magnificent Seven, right? The Qs and the 7 stocks in particular are really leading this latest surge. Commodities are the dollar's put pressure on emerging markets, on the dollar. On commodities, on gold, a lot of pressure on those dollar-sensitive asset classes. When you take a look at the dollar, which has been kind of that big influencer of risk appetite, you notice it had been on a decline, but then bouncing, and you notice right now we're kind of converging between these averages. Are we gonna? Last time we converged, we made a new leg lower. We're gonna make it, the MACD hasn't gone positive. The histogram is trying to turn over. Are we going to pop back down here, make a new leg as we get a death cross? Or are we going to climb back up above the 50 by the time we get that death cross? That's going to have a big time. I expect the latter, but that's going to have a big time impact. Same thing with TLT. Are we going to be breaking down here and moving back down towards these lows, which would have higher yields? The MACD has gone slightly negative, and it's got a lot of momentum to the downside. Stochastics is clearly bearish here. So, again, a lot of resistance to the upside from a volume standpoint, and a lot of gaps here to fill into the downside. That would not be bullish for equities, because that would mean that yields are holding this 4% break and now are themselves making a run above the 200-day average, 30-day average, and maybe potentially the 50. They're at 4.25. That's, of course, that all has to do with rate hike odds, and that's a big influencer lately. And the rate hike odds for March, which is the first one that's on the table right now. January is very unlikely, only a 5% chance of a rate cut in January. But March, there's a 67% odds of a rate cut in January. That's a high number. Still a high probability. Not as high as it was. It was a lot higher before. If you take a look at it here, right now we're at a 65% chance back over here. we were at over a 90% chance. So it's not as high as it was for the first rate cut to be in March, but you can see it's still, below. If this line's below 40, that means the odds of a cut are above 60. If you look at June, however, like the odds of this one rate hike, which would be this purple line is where we're at right now. So this one would be the first rate hike. So the odds of one rate hike are over 90%. And you can see we still have pretty darn high odds for multiple. And when you look at it from this way, you have a 99.9% chance of one rate cut, a 94% chance of two, and then you're looking at about a 56% chance for three cuts by June. That's down from what it was over 62% ago, but still, it's still relatively high. So if this starts to get priced to zero, especially if the March cut gets priced to zero, that's going to have an impact on TLT and, for that matter, TNX. And we've seen how sensitive risk appetite is to movements in these. And so that the market's going to, especially with the CPI coming up tomorrow morning, especially with future employment report, anything that can impact the Fed's decision, not at the next meeting, but just one meeting later, risk appetite, that will largely influence risk appetite. Remember, risk appetite, especially going into earnings season, is very strong. Like the last time that risk appetite was this strong going into an earnings season, right? So when you look at earnings season starting right around options expiration, last October would be the last one, and we were pretty weak going into it. But before that, in July, you can see the 3-month return going into July down here was almost 10%, 9.84. Right now we're at 9.75. That led to a quarter of not so good returns because we were so strong. Back over here we were at 7.5, and that led to a quarter of some volatility. But then in April we were only at 4, and we were able to get a good quarter. So the lower the number going into earnings season on this rate of change, the better. The higher the number, as we've seen, and that means we've already priced in whatever it is we're about to get, and the market tends to sell the news as we get it after they've bought in anticipation of that news. Not surprising to see from a sector standpoint, what's really driven a lot of this action here. Let's see here. It'd be the sector comparison chart. If you take a look here at the sector returns for the past 4 days, you can see it's been all these three. XLK especially, XLC and XLY really outpacing real estate, utilities, staples, healthcare. Industrials is down here too, and financial, so other cyclical areas. So that's kind of showing that it's not really like risk appetite is driving this. It's more, hey, these haven't been doing so well because of the not the reopening trade, but this the Russell's been doing so well. But now you can see the Qs have made one more run, right? One more run up to the upside to close back up above its moving average. Here it's 30-day moving average. Let me zoom in on this ratio chart. You can see we're back above as the correlation remains negative. So whether or not the market can sustain bullishness with this ratio rising remains to be seen, because as you saw, all these other cyclical sectors, especially these economically growth sensitive areas and dollar sensitive areas, materials and energy, are really getting hammered, absolutely hammered during these last 4 days. So again, maybe not as bullish as we think it is. It seems to be more of, hey, let's just buy these Magnificent Seven stocks up. They're such a large influence in these sectors. Let's buy them up, and it's pushing a lot of them higher here. And for that matter, anything related to them. All right, well, that brings us to our trade idea of the day. And what I want to do is I'm going to take a look at McDonald's. McDonald's, interestingly enough, is not in this high growth area, though its chart has been pretty strongly bullish and is bouncing up pretty nicely here in the last couple of days. Well, 2 out of 3. Enough to get the near-term line back above its intermediate line and well into the reversal zone with a good spike on the momentum line to help support that. So even though the intermediate rally is still, like, we're not starting a new intermediate rally, and we're close to the point of control here, and we've been converging for a while, but where MACD is low enough that we could get, a better run up to the upside. The RSI is looking pretty strong, and if you look at the RSI, it's almost back above 60. We're back above 0 on the CCI. Your DMI pattern looks pretty good. You're back above 25 on the positive indicator. Eventually, when it shows up here, back above 25 on the positive, back below 20 on the negative. So it'd be better to get above 30, but again, getting above 30 means you're back above the ADX, which is a good sign too. Again, it doesn't mean we're starting a new intermediate run, but it does mean we might be able to last, on this one a little bit longer as we're back above the green line, strong rate of change. We're maintaining the mature bullish trend. And then your Keltner channel, your bandwidth has really come down pretty sharply, but we're back in the upper quartile of the bandwidth, and we're, again, the bands have come back in. If we can get back outside the bandwidth and Keltner channel, again, we can at least keep this run moving for as long as we can. So what I decided to do here on this trade was to say, okay, well, let's take a look at doing a bull put spread. So we'll sell that mid-30s delta like we always do, buy one strike away, so it gives us a pretty good return on our risk. We need at least $300 for $1,000 of risk. So in other words, we need to have, on a $5 wide, $1.16. I think we ended up getting about $1.25 or 26 on it. On that one. So it's perfect spread, and you can see that break even is right below those lows. So that's what that blue line is. So if we break those lows, then we're going to probably flip this into a bearish trade. But as long as we can maintain support here and continue to move higher with this bounce that we're getting, then that's kind of the idea, right? We're able to take advantage with it as long as we can. Remember, again, knowing that any break to the downside, while we can flip it to a bearish trade, and it would be more directional than what we're doing right now, but we're also hedged for a significant downside move at least in our class portfolio. So I'm able to make these types of bullish trades that have some that don't have the best margin of safety here, because I've covered that margin of safety with the hedge position that we have here. That kind of opens the door to make more bullish trades, like I said, that aren't necessarily starting new intermediate runs, but may be able to continue to extend the ones that they're on, like some of the other recent market outlook trades that we've done as well. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon, comment on the video. Join us at marketscholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.